I have been with Shanks CLA for about 15 years. I do a little bit of everything. I do tax work, tax planning for corporate, for individuals. I do work with small businesses a lot, with QuickBooks, just clean up their books. If clients have like their accountant who quit, I can go in and step in that role and help businesses. So we just want to start with some accounting basics, right? So the basic accounting, we have our two financial statements, right? We have our balance sheet and then we have our income statement. So our balance sheet, it's made up of our assets, which is what we own, right? What do you own? Maybe your checking account, your equipment, your supplies, right? And then your liabilities is what you owe others, right? So maybe the bank, if you have a loan with the bank, or credit cards, maybe you have some transactions they use credit cards for, so that's what you owe. And the difference is your equity, okay? So that's the what you have less what others own of what you have, okay? So this is a snapshot in time of your business. The next basic financial statement is going to be your income statement. And that is going to be like for a year. You have a new income statement every year, okay? So you start with your revenue or your sales for the year, and then we're going to subtract some expenses out of there. Now there's like two categories of expenses. There's expenses that relate to your product, directly relate to your product, right? And that's going to be your cost of goods sold. So if you're a painter, that's going to be like your paint, your canvases, your brushes, whatever. Other expenses then are going to be maybe your rent. Maybe you rent a studio somewhere, or maybe you have insurance, utilities, items like that. So then when we take our revenue minus our expenses that we have specifically for our product, which is our cost of goods sold, then we come to our gross profit. I don't know if anyone has heard that term before, but that's what that is. Then if you subtract your other expenses from your gross profit, you're going to get to your net income, and that's how much you made during the year, right? Which is different than what you have for cash. A lot of people confuse their net income from their cash. Maybe for the year you made money, and you're like, how could I have made money? I have no cash, right? So I don't want people to confuse the two. Net income is going to be different than your cash. When it comes, I think a lot of people ask the question like, I don't know what to charge for my product because I want to make money this year, right? But I don't even know how to start charging. I would kind of work backwards. There's other kind of expenses, like you have your fixed expenses and then you have your variable expenses, okay? So fixed expenses you're going to have no matter what. Like if you rent a studio or something, you're going to have to pay that rent no matter how many paintings you sell, right? But then you have your variable expenses that depends on how many products you sell. So if you sell 20 paintings, those variable expenses depend on how many paintings you sell, which is like the costs that go into that painting, right? Your paint, your canvases. So starting backwards, I would start with the expenses that you know that you have all the time, the fixed costs, right? So you know that you need to cover at least those fixed costs in order to make money, at least, right? And then you know what you have to at least charge because you have costs that go directly into your product. Build a spreadsheet with, you know what your costs are, your rent, and then you don't know how many you're going to sell every year, right? Because your selling price times your volume is going to be your sales number, right? And you know how much cost goes into each of those products. So you could play with your volume. Like if I charge $100 for a painting, and I know it takes me $50 to make that painting, that gives me $50 of gross profit, right? And I know I pay $20 a month in rent, right? So $30 in net income. So if I sold 30 paintings, how does that affect your net income? So I would just, if I were you, I would just build a spreadsheet and play with that volume and then play with that sales price to see how many you would have to sell to get to, obviously you want to make some money, right? To make some money. The easiest way to keep track of your business for the year is to keep accurate records and keep them up to date, right? I know this is probably the last thing you want to do is keep track of your activity for the year. But I would really keep your records up to date, okay? And I would open a separate checking account and a savings account, because it's very important to keep your business transactions separate from your personal transactions, okay? It's hard when you commingle, like if you have your personal checking account with your business activity. And I would try to open a separate credit card as well. If you do have to go to the bank to get some debt, I would try to get that in the business's name instead of in your personal name. And like I said, you want to keep your accurate and timely records. So I would reconcile your bank account that you opened up separately at least monthly, right? So who has one of those check registers yet that they write all their banking activity in? I do, and I probably reconcile it like weekly because, well, maybe my problem is I don't have enough money and I need to know how much I have in there. But yeah, I would definitely do it at least monthly, because how do you know where you're standing, right? If you don't know how much cash you have, okay? You don't know if you're making any money or not. And same with your credit cards. I would look at your credit card statement that you get and make sure that all the activity on that credit card statement is legit, is purchases that you made. So where are you going to record all these transactions, right? You can use a specific accounting software, like there's QuickBooks. I'm sure you've heard of QuickBooks. It's not very expensive, and it's pretty user-friendly. I think for non-accountants, it's really user-friendly. And the upside of that is you can pay invoices, like your bills, directly out of there. You can give invoices to your customers directly out of there. But you don't have to go that route, right? I think you could keep it as simple as like keeping your activity in an Excel spreadsheet. You could keep a running balance of like your checking activity and then just have a different column for each expense. Like here's my my paint, here's my paint brushes, here's my canvases. And then at the end of the year, you add those columns up and then you know where your income and your expenses are. So you don't have to, it doesn't have to be complicated. It can be very simple. So that's just a snapshot of your activity for the year, your checking activity and your credit card activity if you use that. So there's a couple best practices when it comes to actually paying your bills. You would hate to ever get into an IRS audit, right? But if you just follow a couple of items, then there shouldn't be any problems with having all the support to give them. And it's just good to just keep good records for yourself, right? To just be organized. So every check that you write or withdrawal should have some written documentation with it, okay? And then once you like pay that invoice, you should write like paid on it and the date you paid on it, and then the check number if you're writing out checks, and then make sure you just file away. You can file in like a paper file, electronically. I think it's just important to stay organized so that you have all your accurate records. And then one of a lot of questions that we get asked all the time is how long should I keep all this stuff for, right? How long should I keep all these invoices? How long should I keep my tax returns for? One of the handouts is a record retention policy. So it just lays out like based on each kind of document how long you really need to keep records of it. One of the hardest taxes that we have is sales tax. And it's hard because each state is different, and actually each county can be even different. So it can be really difficult, right? And you're gonna encounter sales tax two different ways. When you purchase items, okay, and then when you sell your product, right? So when you purchase your items that you're gonna use, that's called consumables, right? So if it's part of the end product, so if you're a painter, if it's like paint or a canvas, if it's part of the end product, you don't have to pay sales tax on that, okay? And included in that is actually packaging too. You need to have an exemption certificate, and the exemption certificate is this form S-211, and that is actually on the Wisconsin Department of Revenue website, or if you just Google like Wisconsin form S-211, it'll pop right up. So then you just provide them with that exemption certificate, and then you don't have to pay sales tax, okay? Now remember, this is only for the items that go directly into the final product. Okay? It's not always just like you're exempt for everything. It's kind of like what you're buying, right? Because the supplies that you buy is not necessarily exempt. So you don't get to use that exemption certificate for every single thing you purchase, okay? So like, if you use brushes, rags, even your equipment, that it's not going into the final product, right? So that you have to pay sales tax on. Sales tax is like the hardest tax out there. And not only does it like vary by state, it varies by like photography, by industry. Like everybody has special sales tax rules, so it is kind of overwhelming and difficult. But so you can ask us questions. I mean, just give me your email and we'll see what we can get you. Okay. Yeah. So to recap, I guess, consumables, you don't have to pay tax on. You'll give them that exemption certificate, which we're going to talk about. And then other supplies that are subject to sales tax are like stuff that doesn't go into your end product. And use tax, I don't know if you know the difference between sales and use tax. Sales tax you would pay like when you purchase something like brushes or whatever. And use tax is like a self-imposed sales tax. So if you bought something where you should have paid sales tax on it and they didn't charge you sales tax, then you have to really self-impose yourself, and it's called use tax on it. It goes on the same form, it's just a different name. So let's talk about sales tax on if you're selling something, right? So you need a seller's permit to charge sales tax to other people. So if you sell $2,000 a year in sales, you need a seller's permit, okay? I just want to caution you, it goes back to day one of the year, or the day of that year, the first day of your business in that year. So let's say you don't know if you're going to get $2,000 in sales, and you don't get a seller's permit. And it's October, and then you're like, oh crap, I sold $2,500. It's going to go back to day one, and then it's kind of hard to go back to those people and say, I need sales tax from you. So our advice is to just apply for it and charge the sales tax, okay? So if you have a studio, right, you sell something out of your studio that you use the rate. So if you have one in Green Bay here, you're going to use the Brown County rate. If you're, going to art shows, going to craft shows in Door County, you need to use Door County's rate, okay? Which might have a resort tax, extra rates. So different counties might have different rates. There might be counties with the stadium tax rate too. So if you go to the Wisconsin Department of Revenue's website, there's like a nice lookup where you just type in the county and it would tell you the rate for that county. There's one seller's permit for the state of Wisconsin. You don't need a separate seller's permit per county. Each county just has a different rate. Okay, so there's one seller's permit that you'll have to give for the state of Wisconsin, and then when you actually charge your sales tax, it's going to be based on what county you're in. And then that's where you file your sales and use tax return. If you actually make that sale in your studio, someone comes and picks it up at your studio in Brown County here, and then you charge the Brown County rate. If you're shipping it, it's based on the ship-to address, okay, of your customer. In different states, you don't have to pay until, this is different states, until you reach $100,000 in sales or 200 transactions in that sale. Which would be great if you got that, right? But it would be a pain in your butt, okay? So hopefully you make some money, but you don't hit the point where you have to file those sales tax in those other states, okay? It's a lot. Now the real hard thing with the sales and use tax now is like your online sales, okay? If you're using like a Etsy or an eBay or an Amazon, it really depends on your contract with like Amazon or Etsy, okay? So I don't know if you've heard of like this big Wayfair case. Those were like a big hot topic like a year or two ago. And it's based on this. So you used to just have to worry if you were like physically in that state, where now with all these online sales, they call like an economic presence. like you're selling through the internet. So it got really hairy. And that's where we've seen, like, in general, you don't have to worry about other states until you hit the 100,000 or 200 transactions. So here's kind of different options that you have with these online sites. So the best option for you is the site buys all your inventory from you, and then they sell it. And then they are going to collect the sales tax, and they're going to remit it, okay? That's the way you want to go if possible, okay? Because that's the easiest for you, because they just buy all your inventory for you, and then they'll take care of it. The other options are, like, you ship the inventory, and it's going to depend on your contract with them. Either they do it for you, or you're going to have to do it. You really just have to look at your contract with them. Each of them do it different, and I think they do it different with each person too. The good news, though, is effective January 1st in Wisconsin, Amazon must collect and remit on your behalf. So that's good. That is starting January 1st. So the big thing that you really want to try to avoid, though, is if you have like an Amazon or Etsy or something where they hold your inventory in different states, because then you have to keep track of that inventory in those states and then potentially file in those states. It could be a nightmare. But remember, you don't have to worry about it until you hit that threshold.
So when we look at your choice of entity structure, there's a few different options. We have the sole proprietor, which is probably the most common, I would think, in this industry. C corporation, S corporation, partnership, and then we have this thing called a limited liability company, LLC, which an LLC really isn't a type of entity structure. You would file to be an LLC, but you choose how you would want to be taxed then. So you would say, I'm an LLC, but I'm going to choose to be taxed as a sole proprietor. Or I'm an LLC, but I'm going to choose to be taxed as a partnership. So there's no like tax structure for an LLC, but what an LLC can do for you is provide you some limitations from some of the debt, some limited liability for people coming after you personally for some of the debts of your businesses. So we'll just go into a little bit more detail about each type. The sole proprietor, this is just going to be one owner. If you don't set it up as an LLC, you will have unlimited liability. So if you owe the bank through your business and you don't pay, they can come after you personally. It's taxed at the 1040 individual level, typically either the Schedule C, which is for your business, or in Schedule E if you have a rental. You are allowed to take a qualified business income deduction, which this is something new with the tax reform in 2018. And basically what it allows you to do is take a deduction of up to 20% of your qualified business income. And so the reason that the IRS put this into play is because during the tax reform they lowered the C corporation tax rate to 21%. While on the 1040 level, you could be paying up to 37%. So everyone said, well, why don't I just want to be a C corporation now? So what they did was they put this deduction in that ultimately brings your effective tax rate down at the 1040 level. There are some limitations to it, depending on if you're in certain industries, it can be limited. But for most industries, it's just 20% of your qualified business income, which you report on your form. It's limited to, it has a taxable income limit too, but those get complicated. But for the majority of people, say you have $100,000 of qualified business income, you'll get a deduction for $20,000. So the sole proprietor really is the most basic and easiest thing to set up. I would recommend setting up an LLC, which you would just reach out to any attorney or anything like that. It's pretty simple. They have to file like one form article, what do they call them? Articles of organization is what they have to file. And then once you have that LLC, it kind of gives you a little bit of protection from those debts. And you can just select to be taxed as a sole proprietor, reported on your 1040. Really very straightforward. You can put money into your checking account from your personal to your business.
Your separate checking account?
Yes, your separate checking account. You can move from your personal to your business at any time. You can move money from your business to your personal at any time, and there's really no repercussions. Next, we have the C corporation, which there's no limit or on number of owners, type of owners. You would sell stock. Your liability is really limited to the amount you pay for the stock. This is unlike all the other types of entities, and it's actually taxed at the entity level. So C corporations pay a flat 21% federal tax rate, but what C corporations have is called double taxation. So if a C corporation earns $100,000, they pay $21,000 in tax. When they distribute those earnings out to the owners are then going to receive dividends and pay tax on those dividends on their 1040. So a lot of people see the C corporation, they see the 21% rate, and they think it's, you know, really, really great. But we have to watch out for that double taxation too. And then the C corporation doesn't get the QBI deduction, because the whole point of the QBI deduction was to help the other types of entities be a more level with the 21% rate. C corporations, they can be pretty, you know, costly to start. There's a lot more documentation that needs to be done as far as stock certificates, articles of incorporation, etc. So not the most easy to just set up. So then an S corporation, you can have 1 to 100 owners. It is limited to certain types of owners, so only individuals, estates, trusts, things like that can own it. So like a partnership can't own an S corporation, which can be a common entity structure under some other things. The liability would typically be limited to how much money that shareholder puts into the company. And here the income is going to flow out to the owners of this S corporation. Different from the sole proprietor in that the S corporation does have to file a tax return, and then those shareholders will receive a K-1 that they use to report the income on their form. The S corporation doesn't pay tax on their return that they file, but it just essentially calculates the income that gets passed through to the shareholders. S corporations do get the qualified business income deduction, so that information would get passed out to those owners in order for them to calculate that on their 1040. In an S corporation, the shareholders can receive a W-2, they can receive wages, and actually that's something that can be scrutinized by the IRS sometimes, is if a shareholder is taking out money. So I guess we can talk about money coming in and out of this type of entity. So it can be done pretty simply. You can put money in. What we have is basis in an S corporation. So if I put $100,000 in, my basis starts at $100,000. My basis goes up and down for income and losses, and then it goes down for distribution. So if I need to take money out, it's going to be a distribution to me, and my basis just goes down. But as long as you have basis in that company, there's really no issue with money coming in and out.
You don't have to pay tax on it.
Yes, and that's not taxable as long as you have basis. What the IRS does sometimes scrutinize is if the shareholder is taking out a bunch of distributions but not paying themselves wages. And that's because you're not paying self-employment taxes, you're not paying Medicare taxes, FICA taxes, your payroll type taxes on those distributions, but you are paying them via your W-2. So they would argue that the money that you're distributing out to yourself is a wage. So you just have to kind of be careful with that. If you have a really successful S corporation, you just have to watch out for that. And these are pretty easy to set up too. So this, I would say, could be an entity structure, because you only have to have one owner. So if you're a single artist, you could set one of these up for sure. So then we come to partnerships, which can be pretty similar to S corps. You are required to have 2 or more partners. So I don't know how much this applies to artists. I don't know if they typically practice alone or with others. General partners can have unlimited liability. Again, then limited partners, if you create an LLC and elect to be taxed as a partnership, they can limit your liability to just the money you put in. Similar to the S corporation, the partnership files a tax return and gives the owners a K-1 to report that income on their 1040. So no tax paid at the entity level again, but there is a return distributed out to the owners. The partnership does get the qualified business income deduction, so that information gets passed out. Different from the S corporation, there is no W-2 to the partners. You would be paid guaranteed payments, and guaranteed payments are subject to the self-employment taxes. So when those get reported on the K-1 that comes to you. You report those on your 1040. You would pay the FICA, the Medicare, those taxes. you pay the employer and the employee portion, and then you get a deduction for the employer portion because you are the employer. The sole proprietor, if you you're filing your Schedule C, and let's say at the end of the day you come up with $20,000 of income on your Schedule C, that income is going to be subject to the self-employment earnings too. Partnerships, they can start out really easy. You just have two partners, 50-50, everything's split 50-50. They have the ability to get really complex, very intricate with how things get allocated and such like that. They really can vary a lot. So we'll move on. Just some forms when you're starting a business. So I know we talked about the EIN a lot. So the SS4 form is what you would use to get an EIN. So let's say you want to be a sole proprietor and so if you're a sole proprietor and you're just reporting this on your 1040, you technically don't have to get an EIN. You could just keep it in your social security number. But if you want to use the EIN for some of these other things like a seller's permit, et cetera, or an LLC, it just makes sense to set up an EIN and keep things separate. So the SS4, that's an EIN. It's a one-page application or one-page thing. And actually, you can do it right online on the IRS website. So you go in there, you fill it out, and you get your EIN almost immediately. It can also be faxed and mailed in. It just takes a little bit longer to process. And then the BTR 101 is what you're going to use when you're registering in Wisconsin. So this is things like Minnesota, you have a different number. Wisconsin, you would have a different number when you file your sales tax reports, when you get your seller's permit. Things like if you have employees, if you're paying wages, you would use this Wisconsin specific number, almost like an EIN for Wisconsin, on those types of reports. Then we'll just talk about annual forms. So again, this is just going to depend on what type of entity structure you choose. Have an annual return. If you're a sole proprietor, taxed on your individual return, you'll just file your 1040 as normal, add your business income and expenses on there. If you choose to be an S corporation, you'll file Form 1120S. If you choose to be a C corporation, it's Form 1120. And then if you choose to be a partnership, it's Form 1065. So those are in addition to your 1040s every year. If you're paying wages, you'll file W-2s at the end of every year. I'm sure we all know what those are. And then one thing to be careful of, 1099s. So if you pay $600 or more to any non-corporate person for services, so or rent. So if you rent a studio, you need to file a 1099 every year to tell that person, basically tell that person how much you paid them. It tells the IRS how much you paid them. And it's kind of a matching principle to make sure that they report that on their return. So some other things, I guess rent for some studio space or anything like that is probably a big one. If you own a studio or something, if you pay someone to clean it, if you pay someone to maintain the lawn or the driveway, ask them for a W-9, yes, which will give you all the appropriate information that you need from them to file the form. And something with the 1099s that I think has become more prevalent and important since the tax reform is, this qualified business income deduction that we're all really wanting to take now. You have to be a business, right? And one of the requirements of being a business, and this is actually a question that is asked on every return, is did you make any payments that would require you to file 1099, and did you file them? Where if you're just like bypassing it, not filing them, and the IRS says, well, are you really a business? You're not doing these, you're not doing this, you're not filing your 1099s. They could come back with that argument. So that's why I think it's more important to just be aware of this now and be careful and make sure that you're filing the appropriate forms, at least to the best of your ability. Just because I think this is probably going to be the most prevalent form of entity with this group. Just wanted to show you guys, and this is probably really small and you might not be able to read it, but this is Form Schedule C. This is where your business income and expenses would get reported if you're reporting them on your 1040. So just kind of to what Melinda said earlier, you have your income here in Part 1, and over here you have your cost of goods sold. So those are going to be your costs directly associated with your product. And then this Part 2 or 3 down here is just your miscellaneous, other expenses. So we can go, and then we'll talk about a few specific expenses. So car and truck expenses, I'm sure a lot of us are traveling to these shows, to different clients, etc. So there's two different methods you can use to take a deduction for your auto expense. You can use your actual expenses, so your gas, your maintenance, etc., insurance, things like that, or you can use a standard mileage rate. You cannot go back and forth each year between these two methods, so you'll need to choose one and use it year over year.
I think a lot of people probably just use the
Yeah, I would say by and large most people just use the mileage method. So if you are using the mileage method, you need to make sure you keep a log or some sort of documentation on, this date I went to this place for this business purpose, how many miles did I drive for business purpose, etc. If you are using the actual expenses method, you should keep track of your mileage, because obviously there's some personal use if you're using the same car for personal and business. And so some of those actual expenses, if you put $50 in gas, you didn't use all 50 necessarily for business. So you kind of need to do an allocation based on your personal miles and your business miles. I would say to try and keep track of your odometer beginning and end of year, so you know your total miles, right? And then if you can come up with a list, keep records of the miles that you drove for business, by default then the rest are going to be personal probably. Yeah. Some, I've seen very few people keep actually odometer logs. There are actually some good apps out there that you just kind of click, I'm starting driving, this is where I'm going, this is why, this is personal, this is business. So I have seen people use those too. And then meals and entertainment. So meals, so if you're having meals with customers, clients, if you're traveling away from your home to a trade show, or not a trade show, an art show, etc., those types of meals are going to be 50% deductible. There's not many meals that are 100% deductible. I guess if you have employees or something and you have a Christmas party, that would be 100% deductible, but mostly by and large meals are 50%. And then new with the tax reform, entertainment. So if you're taking people out to any sort of entertainment, I don't know, we use Packer games and golf a lot. Those are no longer deductible. And if you have entertainment and meals together, so you're going to the Packer game, you're paying for the suite, they got meals, and you're paying for the suite. The invoice needs to list out the cost of the meals separately in order for you to take those as 50%, otherwise they fall into the non-deductible category. And then depreciation, so if you buy equipment, right, as opposed to getting to expense that right away in the first year, a lot of times you have to put it on your balance sheet and what we call depreciate it over the life of the asset. There is an option to have an automatic policy where you can expense everything that's under $2,500. If something you buy is over $2,500, then you'll have to capitalize that and depreciate it. Now, there are ways to accelerate that expense into 1 year. So Section 179 is one of those options, and that's available for federal and Wisconsin purposes. So, and that's kind of an asset by asset election. So if I buy a new piece of equipment for $10,000, I put it on my balance sheet, I can elect to take 179 on that in the year that I bought it and expense the entire $10,000. And then there's bonus depreciation, which for 2019 here is at 100%. That varies, the IRS changes that. It was 50%, now it's 100. So bonus depreciation, similar to Section 179, but only available for federal purposes, and like I said, varies in percentage. 2019, it's 100%. This you cannot elect on an asset-by-asset basis. You have to elect it kind of for a life basis. So assets can be 5 years, 7 years, 15 years. So if I put in 3 new assets that are all in the 5-year life category, which most of your equipment type things would be, I either have to take bonus on all 3 of those or none of those. So it can't be one or the other. Business use of home. So this is for you, those of you who have a designated area in your home that is used exclusively for your business. So a lot of people try and claim like, oh, I have a home office and I work from home sometimes, but I also work, my main office is down the road. It has to be exclusively for your business. And you can deduct, so your expenses for your real estate taxes, your mortgage interest, your utilities, things like that. Basically what happens is they get allocated amongst the business section of your home and the personal section. So basically just based on square footage. So if you have a 100 square foot studio, you have 1,000 square foot house, it'd be 100 over 1,000. Quick math. No. Yeah. So that's kind of pretty much a business use of home at its simplest form. Any like direct, if you have direct expenses, so you have a studio in your home and you do repairs to your studio, that you would put on as an expense directly for the business. So depending on what kind of expenses you're taking, so if you were just deducting part of your real estate taxes and your mortgage interest and things like that, so basically your real estate taxes, mortgage interest would normally get reported on your Schedule A on your 1040 as a deduction. And when you're allocating them, they just kind of get allocated amongst the business and personal. So once you stop using that area for business, they would all just become personal. And if they're deductible on your 1040, they'll be just deductible in that realm. Where it could get complicated potentially is if you're depreciating that part of your home and you go to sell your house, you could potentially have gain there, but a lot of people don't choose to do that. So there are hobby loss rules. And to be honest with you, I don't know the exact rules about them, but basically they were put in place to avoid people, I think the most common thing is like horses. A lot of people say they have a horse business just because they like to ride their horses and the horses are really expensive and they do this. And so I don't know why but that's used in a lot of court cases. And so what the hobby loss rules intend to do are to prevent you from deducting personal expenses as a business. There are specific rules regarding losses in certain number of years, etc. But I think there's always the argument if you can present your business purpose to, I don't think it's always necessarily just a numbers game. If upon audit that did get questioned, I think they would look to your business purpose too. And are you really, trying to sell, creating this art for resale purposes, things like that, and not just trying to write off expenses as a business that you really aren't intending to treat as a business. To the sales tax aspect of it, I would probably defer to some of our experts for that, but I would say, as to your point about the hobby losses, if you're reporting this on your Schedule C, sometimes we see where we just limit it to zero. So we aren't taking huge losses. So maybe you have a $5,000 loss, but a lot of it was just, your hobby or whatever. Yeah. So take your expenses down to bring your income to zero, and then don't go any further. So don't be reducing your other, your W-2 by your $5,000 loss. That's really where the IRS can come back and argue, hey, this isn't a business. Contributions would get reported if you're a sole proprietor, not on your Schedule C, but on your Schedule A, which is your itemized deductions. And then when it comes to your 1040, you either take the itemized deduction or a standard deduction, which the standard deduction for married filing joint now is $24,000. So a lot of people don't have itemized deductions above and beyond that, so then it really wouldn't be providing you any benefit on your taxes then. Similar, so if you have an S-Corp or a partnership, those contributions would get separately stated on that K-1, and you would, again, report those on the Schedule A. Once you surpass the $2,000 in a year, you technically should have been collecting sales tax for all of the sales up to the $2,000. And so do you technically have to get a seller's permit until you surpass the $2,000? No, or be collecting the sales tax. But it's hard to go back to those customers that you sold something to in January and say, oh, now I'm supposed to be collecting sales tax. Can I get that back from you? So that's why we should just suggest getting it right away and just starting to collect that sales tax right away.